Imagine a stock so enticing that it lured in kings, queens, and commoners alike, promising untold wealth and prosperity. That stock was the South Sea Company, and it epitomized the heights of speculation and the depths of ruin. Within a single year, its shares skyrocketed, only to collapse in what became the first major stock market crash in history. The South Sea Bubble of 1720 didn't just wipe out fortunes. It offered a cautionary tale that resonates to this day. Today, we'll dive into the rise and fall of the South Sea Company, uncover the human and financial factors behind its collapse, and explore how its lessons apply to modern investing in our volatile economic landscape. The story begins in 1711, a time when Britain was emerging from war and drowning in national debt. Enter the South Sea Company, a private enterprise with an ambitious plan. It would assume a significant portion of the government's debt in exchange for exclusive trading rights with South America. The promise of lucrative trade opportunities sparked hope among investors, but there was a catch. Britain's actual trade prospects in South America were slim to none, thanks to Spain's tight control over the region. Despite this glaring issue, the company's directors mounted an aggressive marketing campaign, spinning tales of immense riches and boundless opportunities. Investors, captivated by the dream, rushed to buy shares. Their enthusiasm was bolstered by government support and even personal investments from high-ranking officials, adding credibility to the company's grandiose claims. By early 1720, the South Sea Company's shares were on a meteoric rise. Starting at £128, their value surged to over £1,000 within months. The frenzy swept through all levels of society, with politicians, aristocrats, and even royalty investing heavily. Ordinary citizens, desperate to share in the riches, poured their life savings into the stock. The promise of effortless wealth created a collective mania. But beneath the surface, the company's operations were shaky at best. Its lofty valuation was fueled by speculation rather than real trade revenue. Shady financial practices, including insider trading and manipulation of share prices, added to the instability. As skepticism grew, confidence waned. By the end of 1720, the bubble burst spectacularly. Share prices plummeted, wiping out the fortunes of countless investors and plunging the economy into chaos. The fallout was devastating. Prominent figures were publicly disgraced, and investigations revealed widespread corruption among company directors and government officials. The financial scandal shook public trust and led to reforms aimed at curbing speculative excesses. Yet the damage to individuals and families was immeasurable, with many facing ruin. History may not repeat itself exactly, but it often rhymes. The South Sea Bubble's themes of unchecked speculation and irrational exuberance find echoes in modern financial crises. Let's explore three notable examples. First, the dot-com bubble of the 1990s. Just as the South Sea Company relied on promises of untapped riches, tech startups of the 1990s thrived on visions of a digital revolution. Many companies had little more than a website and a bold idea, yet their valuations soared. When reality set in, the bubble burst, erasing trillions of dollars in market value. Investors who had chased the dream of a tech-driven utopia learned hard lessons about overvaluation and market speculation. Next, the crypto craze of the 2010s. Cryptocurrencies like Bitcoin introduced groundbreaking concepts, but the hype also fueled speculative investments in dubious projects. Investors chased quick gains, often overlooking fundamentals, much like South Sea investors centuries earlier. The volatility of the crypto market mirrors the manic-depressive cycles of speculative bubbles, drawing in those driven by fear of missing out. And finally, meme stocks in 2021. The social media-driven mania around stocks like GameStop and AMC demonstrated how hype can overshadow fundamentals. While some investors profited, others bought in at inflated prices, only to face steep losses. These events highlighted how collective excitement, amplified by online platforms, can create unsustainable market conditions. These examples underscore a universal truth. Speculative bubbles are fueled by human psychology, greed, fear of missing out, and blind optimism. Whether in 1720 or today, the cycle of boom and bust remains strikingly similar. The South Sea bubble wasn't just a financial catastrophe. It prompted significant changes in how financial markets were regulated. In the aftermath, the British government introduced stricter laws to prevent similar speculative schemes. Directors of the South Sea Company faced prosecution, and reforms sought to increase transparency and accountability in the financial sector. Modern parallels exist here too. After the 2008 financial crisis, governments worldwide implemented reforms like the Dodd-Frank Act in the United States to tighten oversight and reduce systemic risk. However, the effectiveness of such measures remains debated, as new forms of speculation continue to emerge. What can we, as modern investors, learn from the South Sea bubble and its parallels in today's markets? Here are 3 enduring lessons. First, scrutinize the fundamentals. Don't be swayed by hype or crowd behavior. Always examine the underlying value of an investment. If a company's promises seem too good to be true, they likely are. Rational analysis is your best defense against speculative traps. Second, diversify your investments. One of the biggest mistakes South Sea investors made was putting all their money into a single stock. Diversification is key to managing risk and protecting your wealth from market volatility. A balanced portfolio minimizes the impact of any single asset's failure. Third, understand the risks. Before investing, weigh the potential rewards against the risks. Speculative assets often carry high risk, and it's crucial to know when to exit. Setting clear investment goals and exit strategies can help prevent emotional decision-making. And fourth, beware of herd mentality. Just because everyone else is investing in a particular asset doesn't mean it's a sound choice. Independent research and critical thinking are vital tools for any investor. By adhering to these principles, we can avoid falling into the traps that have ensnared investors for centuries. The South Sea bubble wasn't just a financial disaster, it was a pivotal moment in economic history. Its collapse highlighted the dangers of unchecked speculation and the importance of sound investment strategies. As we navigate today's complex markets, let's remember the lessons of 1720, that human behavior, more than any market trend, drives booms and busts. Are we witnessing another bubble today, or have we learned from the past? Share your thoughts in the comments below. And don't forget to like and subscribe, and join us next time as we uncover more stories where history meets modern finance.